Welcome to this lecture on multinational capital structure, a critical topic for understanding how global corporations finance their operations. Multinational capital structure refers to the mix of debt, equity, and internal financing that a multinational corporation uses across multiple countries. Unlike domestic firms, multinational corporations don't rely on a single capital market or currency. Instead, they strategically choose where and how to raise funds based on global factors. Key determinants for multinational corporation capital structure include global interest rate differences, exchange rate expectations, and international tax differences. Political and country risk, financial market conditions, and subsidiary cash flow needs also play crucial roles in these decisions. Multinational corporation capital structure is truly a global optimization problem, not merely a domestic one. Multinational corporations operate differently from domestic firms due to multiple tax jurisdictions, access to more financing sources, and currency gains and losses. They also face political and regulatory constraints, along with transfer pricing rules, which domestic firms typically do not encounter. For instance, a US-based multinational corporation might raise capital in Japan at 1% interest, Switzerland at 2%, or the US at 6%, optimizing for cost and risk. Multinational corporations often design their debt structure globally to exploit lower foreign interest rates, weak foreign currencies, and tax shields. They also gain access to broader foreign investor bases, further diversifying their funding options. Global equity financing strategies allow multinational corporations to raise long-term capital without currency repayment risk. They can issue equity in home country stock markets, foreign stock exchanges through cross-listing, or via global depository receipts and American depository receipts. For example, Nestle uses American depository receipts in the US to expand its investor base and reduce equity costs. One of the biggest advantages multinational corporations have is an internal capital market, allowing them to move funds across borders to where capital is most needed. This includes internal loans between subsidiaries, parent equity injections, profit repatriation, transfer pricing strategies, and cash pooling across countries. For instance, a U.S. parent with excess cash in Singapore can lend internally to a subsidiary in Brazil, bypassing expensive local capital markets. Multinational corporations must also consider global risks like exchange rate volatility, political and expropriation risk, and inflation risk. Country-specific credit conditions also influence capital structure, as seen in Argentina's low leverage due to high inflation and currency controls. Conversely, a subsidiary in Germany might have high leverage due to stable financial conditions and low borrowing costs. Multinational capital structure influences firm value through weighted cost of capital, currency exposure, and tax shields from interest deduction. It also impacts financial flexibility and the risk of financial distress. For example, Apple issues low-rate European bonds to lower borrowing costs and avoid U.S. repatriation taxes. McDonald's subsidiaries borrow locally to reduce currency mismatch and match revenue currency with debt currency. Toyota raises capital globally through samurai bonds, dollar bonds, and euro bonds, diversifying its financing risk. In conclusion, multinational capital structure reflects a firm's strategic use of global financial markets, mixing debt, equity, and internal funds based on various international factors. A well-designed multinational capital structure enhances firm value by balancing risk, return, and financial flexibility on a global scale.